US inflation numbers once again surprised to the upside today. However, for the most part, we are seeing the US dollar go sideways. So what's happening here? I'll talk through all of this in today's video. I'll explain why we're seeing the dollar mostly sideways despite an uptick in inflation. We'll also take a look at some key technicals on the EURUSD and also the pound. All right, so let's jump right into today's video. And as always, if you guys enjoy the content, be sure to subscribe to the channel and also click the bell icon for notifications. Don't forget to smash the like button. Now, today I want to start here with the Forex Factory calendar and talk through what we just saw from US PPI numbers. That's producer price index numbers. Those are inflation numbers out of the US. And this is on the back of those numbers that we saw on Tuesday. So let's talk through all of this. So on Tuesday, we saw CPI numbers out of the US. Okay, so all these numbers right here. And what you'll notice is that they did surprise to the upside. So this is what I talked about in the last video where we had forecast numbers for core month over month, 0.3. It came in at 0.4. We had CPI year over year coming at 3.2, and the forecast number was 3.1. So these weren't big numbers, okay? These weren't, huge surprises to the upside. This number right here wasn't like 3.5 or 3.6%. However, it was higher than what was forecast. And what you'll notice is that this number right here was also higher than the previous 3.1. Again, not a huge number, but it is higher than forecast. And the reason that this is significant right now, and the reason markets are hyper-focused on inflation numbers, is because of the Fed. The U.S. equity markets are literally banking on the Fed cutting rates this year. And they are not going to be able to cut at the rate the market expects, not even close to it, if inflation remains sticky, especially if it starts to uptick like it is over the past few weeks. Okay, now we'll get into all the technicals as far as the DXY, the EURUSD, and the pound USD in a moment. But I do want to show you this chart because I think it's significant in terms of what's happening right now with inflation. And just a side note too, guys, I am not a fundamental trader. I'm a pure technical trader, 100% technical. However, when there is data like this, I want to bring it to you guys because I think it's significant for these markets. All right, so we're going to also take a look at why markets are continuing higher, why U.S. equity markets are continuing higher despite the fact that inflation remains relatively sticky. So the issue right now, and what I think is going to happen with inflation, is that this right here, okay, you see this kind of plateau, right? Inflation was making great progress back here, coming off of that COVID stimulus, right, that started back here. So we obviously saw a huge move in inflation up, and inflation since that peak has come off significantly. However, for quite a while now, we have seen inflation just remain sideways. So what I think this is telling us is that this is potentially a higher low, if you will. Okay, this is potentially a higher low from inflation before either it remains sticky and pushes up slightly, or we get something like this, okay? Now, that's a very unpopular opinion. I think most people right now, especially those involved in U.S. equity markets, are looking for this to come off. And personally, I think there's a lot of confirmation bias in that. But of course, we will have to wait and see. But I think that inflation is going to remain stickier for longer, guys. And today's PPI also kind of supported that with, you can see here, core PPI month over month came in at 0.3%. The forecast was 0.2%. And you can see here, once again, this is a big surprise to the upside, 0.6% over 0.3% forecast. 0.3% was also the previous number. So this right here was a big surprise to the upside for month over month. Annualized, guys, that is not a good number. And markets are not going to like that. So let's talk now why U.S. equity markets haven't really cared about this and why the DXY, we're seeing an uptick today in the DXY, but for the most part, even with those CPI numbers here on this candle, why has the DXY not really moved higher? Because in any other environment, the DXY would have taken off on those CPI numbers, right? So the reason that the DXY remains sideways and literally subdued here is the fact that when you look at equity markets, U.S. equity markets like the SPY, the S&P 500 has been obviously on an incredible tear ever since back here in late last year. Okay, this entire move up is liquidity driven. That's it, plain and simple. It is a liquidity-driven move. These markets do not care about what's going on with inflation, at least not yet. It's also been a tech-driven move. It's no secret that, the whole AI boom and everything else has kept these markets afloat, especially with markets like NVIDIA. Personally, I think it's way overblown, and I think that this is all going to come back to earth at some point when the market realizes that, yeah, AI is great, but we're not quite there yet to sustain the kind of valuations we see out there. But regardless, guys, you look at a market like this, and you can see, obviously, huge rising wedge here on something like the SPY, and this tends to move inversely to the DXY. So the reason the dollar has remained subdued and we've seen markets like the EURUSD and the pound USD rally is because of these liquidity-driven moves over the past few months. And a lot of people don't realize it, but when you look at a market like the EURUSD or something like the pound, these tend to move with equity markets. Not exactly, okay, but they do tend to perform better when you see US equity markets doing this. All right, so let's talk through technicals now, knowing that inflation once again surprised to the upside today. And personally, guys, I think that the DXY right now, if I can compare this to something in real life, I would say that this is very akin to an inflated ball being pushed underwater, right? We've seen it pushed underwater time and time again, despite inflation numbers showing surprises to the upside. And again, it goes back to those liquidity-driven moves that we've seen from markets. So to me, it's only a matter of time before we see a potential bottom form here and the dollar begin to rally again. Now, the key for this market, okay, the key for the DXY is going to be 103. We've talked about this before, but you can see we've got this high from right back here. We've got all of these lows, and you can see here so far this week, right on the mark. Look at yesterday's high, right off of 103. So if the DXY reclaims 103 today, which so far it's taken out this week's high, if it can close above this, which, make no mistake, there's still a lot of time left in this candle. There's over 8 hours left in today's session, so this could go either way. So waiting for the daily close is going to be key, but if we see a close above this 103 number, then that could be the start of a potential bottom. Now, an even bigger test is arguably this area between 103.5 and 103.8. This is going to be a significant resistance for the dollar. Okay, so make no mistake about it, that's going to be a big test for dollar bulls, to where even if we get a close above this, it doesn't mean that the dollar is just going to do this, because it has to get through 103.50 to 103.80 first. But again, I think that a reclaim of 103 would be significant if we get it. That's the big if. And you can see back here, something very similar occurred with regard to this 101.9 level. So notice back here was support again through here. We had, at the end of 2023, we had the move below this, and 2024 started out with a reclaim of that key level. Note what became support right after. So this right here is kind of looking very similar if we get the reclaim of 103, to where you can see this down here became our fake out, and this is potentially a fake out that's forming if we get the 103 reclaim. But again, this region up here is going to be critical for the dollar. And alternatively, of course, if today were to close back below 103, that level remains intact as resistance, and we're looking at 102.6 as key support. All right, so let's flip over now and take a look at the EURUSD, which right now is having a little bit of trouble staying above that support area. It's still above it as of now, but this is something that I'm not fully convinced on. And I'm really not convinced with the pound, which I'll show you guys next, and why I'm not convinced with the rallies that we saw last week. So this trend line right here, off of that 2022 low, we've got all of these closing prices through here, and you can see where this level was resistance for the euro for several weeks. Now, we did see last week close above this area right around 1.09. Okay, so you can see back here too, this is a pivot, lows back here, highs through here, and you can see this high and this recent low. So the key for the euro is going to be this area right around 1.09. This is what I've talked about in recent videos, and you can see where the euro is testing that level right now as I make this video. So as of now, this is still support. Okay, so you don't want to go out shorting this market right into a key support level like that. But if we see the DXY reclaim 103 and the EURUSD trades down here this week, okay, a daily close down here in this area this week, then this up here becomes a fake out. It's nothing more than a sweep of this high back here. Okay, and that would be bearish toward areas like this down here, these lows around 1.08. Now, of course, we've also got these highs through here, so you can make the case that this is also going to be a support level right around 1.0865 or so. All right, and that probably lines up too, when we look at the DXY, that probably lines up with this area around 103.5. Okay, so we do have some support along the way, but the euro is at risk of losing that level if it closes below 1.09. So we're not there yet, still 6 hours left in the day. A lot can happen here, guys. Again, I don't think this is the time you want to be shorting, because you would be shorting the market right into key support. All right, now let me show you why the pound, I'm really not convinced by last week's move here. And this goes back to a recent video that I made regarding this high from back here in December. So this high up here at 1.2825, you can see where right here on this candle, this red candle, okay, the market closed below it. Now, at that time, you could make the case that the pound was holding above the closing price from back here in December. Okay, so on a daily closing basis, you can make the argument that this close back here in December, that this red candle was still holding above it. However, look what happened the very next day. Okay, the market lost that level. Look what happened yesterday. The pound tried to rally above, but it failed. Look what happened once again today. The market tried to rally and failed right there from 1.2825. Okay, so as of right now, guys, this, in my opinion, is telling you that the odds of this up here becoming a fake out, okay, becoming a mere sweep of this high from back here in December is increasing. Okay, those odds are increasing. Now, we do need to see the pound close below all of these highs back here. I think that would really solidify it if we were to get the pound closing down here in this area sometime this week. All right, so again, we've got plenty of time left in today's session, over 6 hours. A lot can happen here. The market could close back above this. It could close back above this trend line, which, by the way, this trend line right here that you see runs parallel to the bottom of this channel. Okay, so you can see moving all the way out here on the daily chart, going back here toward 2023, you can see this channel right here. And this trend line off of these lows runs parallel to this one right here. So this is essentially just a channel that's developed. And we did see the pound close above it last week. But again, if we see a sustained break below 1.2770 on a daily closing basis, okay, down here in this area, then this up here, okay, this recent move last week becomes a fake out. And as many of you guys know who have followed me for a while now, a fake out like this to one side of a pattern or level tends to produce an extended move in the opposite direction. So for that, I think we'd be looking at a move back here toward these 1.27 highs and potentially the top of that channel down here around 1.265. And that would likely be just the start, in my opinion, because again, if this becomes a fake out, okay, still a big if, but if it were to become a fake out, then we're looking at an extended move in the opposite direction, likely down here toward these lows and potentially even lower. All right, but we'll see where this lands. I mean, as of right now, again, there's still 6 hours left in the day. This could easily close back above that key area, in which case it would remain intact as support for the pound, and we could still be looking at that rally up here toward these highs. Okay, specifically around 1.3, 1.314. But right now, though, it is looking, relatively weak. We have the market kind of breaking down today, showing that it's really struggling to stay above these highs that it closed above last week. It's already failed to hold above the high and closing price from back here in December, right? Remember, on this candle right here, it lost it. And so far today, it is below these highs from back here, but we still have 6 hours before the daily close. All right, so ultimately, just kind of wrapping up, I think that inflation, guys, in the U.S. is more likely to remain stickier for longer than many expect, especially U.S. equity markets. They're really calling the Fed's bluff and expecting the Fed to cut, significantly this year, and far more than I think the Fed is actually going to cut. That's just my opinion. We'll have to wait and see how all this unfolds. But to me, this move right here we've seen from equity markets is purely liquidity driven. The question is, though, how long can markets keep an inflated ball, right, like the DXY underwater without it surfacing, without it popping up? And so far today's session, we are seeing early signs of that. But again, we don't have a daily close above 103, so we can't say that this is a reclaim as of now. So as of this video, this area at 103 is still resistance on a daily closing basis. Okay, daily closing basis being the key word there. So either way, this should be interesting to see how it plays out. Can the DXY reclaim 103 or not? And that's really going to dictate how I approach pairs like the Pound USD and also the Euro USD. Be sure to subscribe to the channel and click the bell icon for notifications. Don't forget to, guys, grab your 70% off VIP access. See the link in the description of this video. Trade well out there, and I will talk to you again tomorrow.